So welcome back. Let us continue with the determination of net profit or loss. So determination of net profit or loss. Remember, previously we were discussing on preparation or determination of the gross profit. Gross profit, we said it is sales, the net sales minus the cost of sales. We did not touch on other expenses incurred by the business. So, in our today's lesson, we now want to consider other expenses that are incurred by the business in its normal operations. So, when you get the gross profit, you also need to deduct other expenses that are incurred by the business, including the administrative expenses, sales and distribution expenses, finance costs. Interest is what we refer as finance cost, so that we can determine the net profit generated by the business in the course of the year. So we did it together. After ascertaining the gross profit, the subsequent step is to ascertain the net profit or loss during an accounting period. Here, the revenues and expenses of the accounting period are summarized to reflect the alterations in various critical areas of the firm's operations. This step indicates how the revenue, that is money received from the sale of products and services before expenses are withdrawn. It is transformed into the net income, the result after all revenues and expenses have been accounted for. It displays the revenues recognized for a specific period and the cost and expenses charged against the revenues, including write-offs, e.g., depreciations and amortization of various assets. Remember, we said depreciation is the loss of value of fixed assets, while amortization is the loss of value of intangible assets. Intangible assets like goodwill. When the intangible asset like goodwill lose value, we use the term amortization or impairment or amortization. So, and the taxes. So the objective of the income statement is to explain to the managers and the investors whether the company made or lost money during the period being reported. As pointed out earlier, the gross profit or gross losses ascertained in first step, which becomes the starting point of the ascertainment of the net profit or loss, it takes into consideration all remaining indirect normal and abnormal expenses and losses related to or incidental to the business. These operating and non-operating expenses are charged as shown to the debit side of the account. After transferring the gross profit or gross loss, the sources of other incomes like commission or discount received are shown on the credit side. The credit side also includes the non-trading income like interest on bank deposits or securities, dividend or on shares, rent of property let out, profit generated out of the sale of fixed asset, etc. On the debit side will appear all other expenses that appear in the trial balance but cannot find a place in the trading account. The debit side will also include the losses arising out of sale of assets and any abnormal losses. The net income is measured by matching revenues and expenses. The net income is the difference between the total revenue and the total expenses. Total revenue and the total expenses. Items to be debited. Items to be debited. Items to be debited. So remember, when we talk of items to be debited, we simply means the items to be charged in the P&L as expenses. Items to be charged in the P&L, in the profit and loss account, as expenses. That is what we mean when we talk of items to be debited, because all expenses are debited, all incomes are credited. So one is management expenses. Management expenses, remember, this is what we are calling administrative expenses. So these are the expenses incurred for carrying out the day-to-day administration of a business. Expenses under this head include office salaries, office rent, and lighting, printing, and stationery, and telegrams, telephone charges, etc. Another expense, number 2, is selling and distribution expenses. Selling, remember, as the business sells its goods, it also incur expenses in connection to sale of goods. So these expenses are incurred for selling and distribution of products and services. As the name indicates, they comprise of commission and salaries of salesmen, advertising expenses, packaging, bad debt, etc. So those are the expenses related to selling and distribution. Number 3 is maintenance expenses. Remember, in the business, we also keep doing repair and maintenance to some of our assets in the business as a normal operation. So the financial, that is the maintenance expenses. These are expenses incurred for maintaining the fixed asset of the administrative office in a good condition. They include expenses towards repair and renewals. Another expense is known as that is number 5. Number four, financial expenses. So financial expenses, as the name suggests, is a matter to do with financing of the business. So this is where we shall factor in the cost we incur when we borrow money from the bank, e.g. the interest. Interest, remember, is a cost associated with money borrowed to finance the business. So financial expenses, these expenses are incurred for arranging finances necessary for running the business. These include interest on loans, discount on bills, brokerage and legal expenses for raising loans, etc. Abnormal losses. Remember, we said that the income statement is prepared under normal circumstances. But sometimes the business incurs abnormal expenses or abnormal losses. So some abnormal losses may arise during the accounting period. All types of abnormal losses are treated as unusual expenses and debited to the P&L account. Examples are stock lost by fire but not covered by insurance. So that will be a loss. Loss on sale of machinery, we call it the loss on disposal. Another one is cash defalcation, etc. So sometimes the business may lose cash, maybe out of dishonesty of those people who had cash in the business may lose cash. Maybe cash is stolen by some of the service providers in the business. They may steal cash, and maybe some of them may leave the business without returning the cash that was on their heart, as at the period they were leaving the organization. So another expenses is wages and salaries. Wages and salary, remember, this is the amount of money paid to those people who provide services to the business. Those employees who provide services to the business, they are paid wages or salaries. Remember, wages is what we pay maybe on a daily basis. Salary is what we pay at the end of the month. Some workers are not engaged in the business on full-time basis, and therefore they receive wages. But those workers who are engaged by the business on full-time basis, what they receive is what we call salaries. So wages and salaries earned by the workers, whether paid or otherwise, and rent, electricity, telephone expenses are to be taken into consideration, whether paid during the accounting period or later. To ascertain the amount of expenses to be debited to the income statement, 4 types of events are essentially considered, and then the cash payment is made in connection with these events. They are as under. So the events include number 1, expenses incurred and paid out in that year. Expenses incurred and paid out in that year. If some particular expenditure is incurred in a year and paid in the same year, the same will be debited to the income statement. Number 2, expenses incurred but not paid out, partly or fully. Remember, in our income statement, the concept that we use when we are preparing the income statement is the accrual basis of accounting. So the accrual basis of accounting we are supposed to charge expenses whenever they are incurred, not necessarily when they are paid for. So we account for expenses when they are incurred, not necessarily when they are paid for. So expenses incurred but not paid out or partly or fully during the current year. There are some expenses which are incurred in the current accounting period but not paid for, partly or fully. By the end of the period, they are called outstanding expenses. In other words, you call them accrued expenses. So accrued expenses, outstanding expenses, expenses that have already been incurred, yet they are not paid for. They are not yet paid for by the end of the year. So these expenses become liabilities of the business at the end of the accounting year. So when we go to the statement of financial position, the expenses that remain unpaid by the end of the year, they form part of the current liabilities in our statement of financial position. They become current liability in our statement of financial position. So these expenses become liabilities of the business at the end of the accounting year. In fact, on the date of the final accounts, outstanding expenses in the form of both the expenses and a liability exist without having been recorded in the books of account. For recording it, the following entry is to be passed. The following entry is to be passed. So expenses account, we debit, will be shown in the income statement account. So we debit the income statement account. To outstanding expenses account will appear in the liability side of the statement of financial position. Statement of financial position. Number three, expenses paid for during the current year but not incurred as yet, partly or fully. So we shall refer to these expenses as prepayment. Sometimes you may find that you have paid for expenses before you incur those expenses. Especially assuming that we are in the month of March, and you pay the rent for the month of April, May, and June, but you are still in the month of March. So it means that you paid rent in advance. Or you simply paid an expense before the services have been provided. So that is what we call prepayment or prepaid expenses. And in our statement of financial position, it will form part of the current asset. Current asset known as prepaid expenses. So prepaid expenses will form part of the current asset. Expenses paid for yet not incurred. Expenses paid for yet not incurred. So that is what we call a prepayment or a prepaid expense. So expenses paid for during the current year but not incurred as yet, partly or fully. Sometimes it may happen that some expenses are paid during the current year but are not incurred as yet, partly or fully. Those expenses are known as prepaid expenses. Prepaid expenses is an asset to the business and will be shown in the statement of financial position. The adjustment entry to be passed is, so we debit the prepaid expenses, that is to be shown as a current asset in the statement of financial position. Then we credit to expenses account. We credit to the expenses account and the balance of this account to be debited to the income statement account. Number 4, expenses of the current year likely to arise in subsequent period. Expenses of the current year likely to arise in the subsequent period, in future period. So sometimes an expense or a loss may arise in the future in connection with the current year's business. In such a case, we make a provision for the anticipated loss and a charge is created against the profit for the current period. This provision is known as either a liability or a contingent asset, i.e., it appears in the statement of financial position as a deduction from some other assets, and the best example of these anticipated expenses is the provision for bad debts. Remember, the word provision means money set aside. So we have not yet incurred this cost, but since we are anticipating a loss maybe to happen in future, to be on the safe side, we set aside some amount of money to cater for that loss when the time arises. But for now, you have not yet incurred, but in real sense, you are anticipating or you are foreseeing that in the future you will incur a loss. So we are saying that a good example is provision for provision for bad debts. So provision simply means that you are doubting that some debtors, may not pay. Since you are doubting that some debtors will not pay on due date, then it's always good to take precautionary measures and set aside some amount of money today, so that when you incur such a loss, you still be safe. So you have the items on the credit side. You have the items on the credit side of the income statement. So when we talk of the credit side of the income statement, we simply means the items of income. So incomes is what we put on the credit side of the income statement. Expenses are put on the debit side of the income statement. So items on the credit side of the income statement are simply the incomes. So the items that will appear in the credit side of the income statement account can be broadly classified as other. Gross profit, what we refer as GP. So gross profit is one of the income that will appear on the credit side of the income statement. So this is the balance. Sorry. So this is the balance of the trading account transferred to the profit and loss account. If the trading account shows a gross loss, it will appear on the debit side. Other incomes, sometimes a business might generate some profit which is not due to the sale of its goods or services, because the business may have some other sources of financial income. Examples are the discount or the commission received. Number 3, non-trading income. Non-trading income, so this is simply the income you generate from other activities which are not your normal business. So the business may have various transactions with the bank. At the end of the year, the business may earn some amount of interest, which will find a place in the P&L account as a non-trading income. The business may have some investment outside the business in the form of shares, debentures, or units. All sorts of gains obtained from such kinds of investments are considered as non-trading income and treated accordingly. Number 4, we have the abnormal gain. So what is abnormal gain? There may be capital gains arising during the course of the year, e.g., the profit arising out of sale of fixed asset. So when you dispose a fixed asset at a gain, that is not a normal profit, because normal profit should come from the normal sale of stock. But when you sell a fixed asset, remember, a fixed asset is not intended for sale. It is used in the business. So in the event you sell a fixed asset and you make a gain on disposal, it is treated as abnormal gain, or simply it is added to the income statement by crediting the income statement. We must remember that all incomes from the abnormal gains or other incomes should be credited to the P&L account if they arise or accrue during the period. Similarly, the income received in advance should be deducted from the income. So another area is ascertainment of the net profit and loss. ascertainment of the net profit and loss. Once the respective accounts are transferred from the trial balance to the income statement, the gross profit or loss ascertained and all adjustments are taken care of, the income statement will now be balanced. The totals of debit side and credit side are computed, and the difference between these totals is either a net profit or loss or net loss. If the total of the debit side exceeds the total of credit side, there is a net loss. Whereas when the total of the credit side exceeds the total of the debit side, there is a net profit. Net profit is the last item to be recorded on the debit side, else net loss is the last item on the credit side. After computing the net profits to close, the totals of two sides of the income statement match, or should be balanced. So the balance in the P&L account represent the net profit or net loss. If the credit side is more than the debit side, it shows the net profit. Alternatively, if the debit side is more than the credit side, it shows the net loss. When the profit and loss account shows a net profit, we pass the following entry. We debit the P&L account and we credit the net profit. If the profit and loss account shows a net loss, the entry will be reversed. The entry will be reversed. So we have the format for the profit and loss account. We have the format for the profit and loss account. Remember, we said we start with a computation of the gross profit. And how do we determine the gross profit? We take the net sales minus the cost of sales to get the gross profit. So as discussed earlier, we have the sales. You have the sales. You less the return inwards. Then you less the cost of sales. Cost of sales, we said it is made up of cost of closing stock. That is opening stock. You add purchases. You add carriage inwards. You less return outwards to get the cost of goods available for sale. Less the closing stock to get the total cost of sales. From the net sales, you less the cost of sales. You less the cost of sales, and then what you get is the GP. That is the gross profit. The gross profit is what you get. So after the gross profit, you add other incomes, other non-trading income. Other non-trading income, a good example is the discount received, rent received, interest received, other incomes to get the gross income. After you get the gross income, then you determine the other expenses so that you can determine the net profit. Other expenses may be carriage inwards. Remember, carriage inwards, we said should be carriage outwards. So carriage outwards is the transportation cost that the business may incur when selling goods to customers. So when you sell goods to customer, you may facilitate the customers with transportation, what we call the after sale service. So you offer transportation service to customer. What you incur is the carriage outwards. Then the discount allowed is also an expense. The discount allowed, so a customer was supposed to pay 1,000, but you offer a discount of 100 shillings. and therefore the customer will pay 900 and not 1000. That is an expense of the business. 100 that is lost due to discount is an expense of the business, and therefore the discount allowed is an expense of the business. Postage and stationery is the normal administrative expenses, salaries and wages, rent paid, insurance and rates, bank charges, other expenses, including depreciation expenses. All those expenses are determined and are deducted from the gross income so that you can determine the net, so that you can determine the net profit, that you can determine the net profit of the business. Determine the net profit of the business. So that is all about determination of net profit, and also the format, the format. So in our next lesson, we shall go through an illustration. And then we see how we prepare the income statement of a sole trader, so that we can move forward to preparation of the statement of financial position. Goodbye.